Hi, it's Jeffrey Walkenhorst from CommonStockEnse.blogspot.com. I was a guest speaker this week at an investor forum here in New York City, and while the event was not webcast, I was planning to post my slides on the blog, and it occurred to me that I might also post the slides with a brief video clip, hopefully no more than 10 minutes. I'm going to try to run through this very, very quickly to give you some highlights from some of the slides. You can also download the slides and follow along that way if it's easier, because it may not appear that great through the video. And here we go. The title of the presentation was Which Way From Here? And it is our approach to navigating through the current markets. So I'll talk about where we've come from, talk about a little bit of economic data. We'll say, okay, well, some of the easy money's been made, yet there are a lot of mixed signals about the economy and where things are headed. And we'll talk about an approach that we think makes sense in all markets, in some areas where we see opportunity. Of course, there are risk factors with anything, any investment, so please consider those and invest at your own risk. Here we go. So over the last year and a half, 2 years, the human psyche has really gone through the ringer. And back 2004, 2007, look, life was good. The music was going, and I think, well, many people thought that real estate was a problem. No one knew exactly when the music would stop, so life continued on until all of a sudden, wow, foundation cracks, and then all of a sudden in late 08 we have shock and awe, which continued into early 09. And this is something that we talked about with folks that we had conversations with, and we said, look, this is a natural process of sort of self-actualization in a way, where we go from this shock and awe to then realization, which I think we've kind of gone through, and now we're in this period of acceptance where you grin and bear it, move on with life, and things are not easy, and we're not saying that we're out of the woods necessarily, but I think we're in a better place than we were, say, a year ago, and at some point the cycle, of course, repeats itself. Now, stepping forward, this is maybe a more elegant way to look at this. This is a popular schematic that you can see on the web, and various market strategists use this in their presentations. And it shows that, look, the arguably markets and psychology move in tandem. And I say arguably because at any given point in time, there may be one person that says, look, we're somewhere here, when others might think that we're down here. So it's hard to know exactly where we are. But it seems as though we've moved off the bottom of this time of maximum pessimism. What are some of the lessons that we've learned? Well, too much leverage is usually a bad thing. Emotions can drive markets to extremes. The late Sir John Templeton was famous for saying, not only being a great investor, but always saying or recommending that the time of maximum pessimism is the best time to buy. And then we could also say, well, Warren Buffett says, okay, the same way, be fearful when others are greedy, and be greedy when others are fearful. Number 4 lesson, dollar cost averaging can work if you buy at the right price. So you wouldn't necessarily want to buy something that's egregiously overvalued, but if you buy with a price discipline in mind, or your 401k continues to purchase, that's usually a good thing through market cycles. The next thing is that forecasts are often wrong, and this is actually one of our former colleagues at Bank of America, Mickey Levy. He's the chief economist, smart, very bright, and thoughtful in his research. He stuck his neck out in fall of 07 with an article that was both published as research and also in the Wall Street Journal, and say, no recession in sight. And we all know what happened there. So many folks usually get it wrong. And next, 100-year storms seem to happen once every decade, sometimes twice. And during these times of these black swan events, which seemingly are outlier events and shouldn't happen that often at all, when that happens, diversification means less and doesn't help you as much. And of course, we would argue that diversification still makes sense from a risk management perspective, and especially over time. So you still need to consider it. And this is something that I'll just point out very quickly. This is some research from Vanguard that actually shows that, wow, your correlations in 2008 were very close to 1 for many different asset classes. So looking at economic data, where are we now? It's mixed. We see durable goods orders that have bounced off the bottom. Of course, now we're in a period of easy year-year compares, and you see month-month data that is kind of bouncing around stability, but no great rebound as yet. Now, this is a piece that came from a Federal Reserve Board of San Francisco research piece that was out just a couple weeks ago that showed or studied real house prices in developed markets and showed that most of these are European countries, and then you have Japan here as well. It showed that prices were out of control all over the map, and what's concerning is if you look at Germany and Japan over the last decade, they've been on a downward trend. We wouldn't be surprised, given how long real estate runs, we would not be surprised to see that trend occur in the U.S. And the U.S. is now kind of up here. We've just started to kind of turn south. So we'll have to monitor that. But at the same time, the good news is housing starts have bottomed, so that's looking a little bit better. Now, non-farm payrolls, sentiment, trade, all improving. This is non-farm payrolls. At the top, these are your monthly job losses, and we're almost back to zero, break even, but not quite. And then here we see that the total non-farm employment, which is somewhere around 130 million persons in the U.S., is about back to where it was, maybe in 2003, and then you have to go back to possibly 2000 or the late 90s to get back to where we are. And this is what we hear about in the press. Wow, we've lost roughly 5 million, 6 million jobs. How on earth can we get these jobs back? And I'll talk on that in a second. This is consumer sentiment. We've bounced at the bottom, coming back up. And then this shows the trade balance, and it shows that imports are improving, exports are also moving higher. So that's a good thing, although we still have a trade deficit, but it's nothing new. So looking at some of the stocks, okay, easy money's been made, no question. If you had the fortitude, the stomach to step in and buy in the spring of 2009, you've probably done very well. This is a sampling from the retail sector, and Whole Foods, Tiffany, Williams-Sonoma, and Limited Brands, all pretty much household names, well-known companies, arguably, strong balance sheets and likely going to survive, and you probably could have made that assessment back when things were so dire, and now you have share prices that have doubled, tripled, or quadrupled in some cases. So that said, we have mixed signals on the economic front, and there are plenty of headlines that come in the press that are concerning, and one is this: a decade of high unemployment is looming, what's going to happen, and weak consumer spending. Then you have the whole China worry: is China a bubble? What's going to happen? You have global imbalances. Then you have different perspectives. You have two headlines on the same day, one from BBC, one from the Associated Press, that focus on different things. From the IMF head that says, oh, double dip's a possibility, and then, oh, recovery stronger than expected. Okay, and then you have some news that says the Fed sees recovery spending in the U.S. Stronger than expected. However, economic activity is at a low level. So we don't have the answers to these questions, and actually, if you think about these questions, it will drive you batty and quite possibly insane, and you'll lose sleep, and that's what we try to avoid. So our answer is that, look, short-term forecasting is really a fool's game, and there was a study, we're not going to go through this in great detail, but there was a study in 2004 by some psychology professors at the University of Stockholm, or Stockholm University, which showed that lay people on a short-term basis over the course of 1 month tend to do much better than professionals. In fact, professionals performed worse than chance. So you would expect that over the short term, the market movement is really a guessing game. It's 50-50. We don't know what's going to happen. So it's amazing that, and so the professionals were repeatedly wrong. And they, on average, was around 40% of the time they were correct, whereas the lay people were about 50% correct, which is just about the same as flipping a coin. So think about this in the context of mutual funds, where your average annual turnover is around 200%, which means the average holding period is 6 months, which is crazy. So, I mean, essentially, these funds are chasing directional moves in the market, and in fact, they are the market because they're constantly churning through the portfolio so much. And also hedge funds, although different strategies can be successful and they have put up some good performance, that many times they're so short-term focused, which can be essentially gambling.